We'll count down this from five. All right. Five, five, four, three, two, one. On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger. My friend and co-host Tobin Smith is away on assignment right now, but we'll hear from him later on, I'm sure. But things are going great with him. As you saw yesterday with Money Mavericks, he had Danielle Shea on and as his featured guest. And if you missed that show, definitely want to check out the on-demand lineup just to see what he had to say with Danielle. But with me today is Scott Ladner. He is the CIO of Horizon Investments located in Charlotte, North Carolina. And Scott, we were talking about this market right before we went on. I mean, the week ADP number is one thing, but it's kind of giving some traders thinking that maybe the Fed is definitely going to be cutting on September 17th. But what's your call?
Yeah, Todd. I mean, I think first of all, thanks for having me on again. It's always awesome to be on y'all's show. It's a unique setting, and you guys are awesome. So
Absolutely.
it's look. I think the market's got this one about right. Powell basically said almost no matter what happens in the data, they're basically changing from being data dependent to being forecast dependent. And the forecasts are relatively clear that the labor market is slowing, inflation is slowly coming down, it's being a little bit stubborn, but it's we're like as my grandma used to say, like we're gaining on it. And it's and they think they're restrictive. I mean, by their Fed's models, they are restrictive right now. So if you've got a labor market which is weakening and inflation which you're not really concerned about, and inflation expectations still relatively anchored, and you're restrictive, the recipe for the sort of the answer to that cocktail is starting to cut rates and get basically back towards neutral again. So I don't think there's almost any number, frankly, that could come out tomorrow in payrolls that would force them to deviate at least in September from a cut. I mean, I think they're going to get going. If things really start to turn for the worse or for the better, materially for the better, that might change the calculus for October and December. But as far as September goes, unless it's just a wild number one way or the other, it's like sort of that cake is baked and we're going to eat it on the 17th.
So I saw you've been all over the news lately, and I can see why. You bring a lot of value to the audience for what they hear your thoughts and your comments. But you mentioned to another outlet that you were still expecting two cuts for the remainder of the year. Is that still the case?
It is, and again, like, look, it's sort of boring to be consensus and boring to be where the market has it priced. But in this case, we think the market's got it right. I mean, they probably got to cut, between 4 and 6 times over the next 18 months, and it's like sort of like the rapidity with which, or sort of like the cadence of when those cuts actually come. And it doesn't matter that much. I mean, it matters some, but it doesn't really matter that much. And so, two this year is kind of where the dots were and kind of where they're sort of the guiding places, and that's where the market has it priced. And then, again, barring something kind of really wild happening especially on the labor front, that just does seem like a fairly benign, predicted, easy, boring outcome. I mean, look, Todd, I mean, I think at the end of the day, if we can get off the place where we're talking about the Fed being sort of the market, the mover of markets and being like super important. Basically, the Fed can be de-emphasized a little bit as we come into 2026 and become a little bit more boring and predictable. Look, that's not a bad thing. If we
Right.
can start talking about fundamentals, we can start talking about fiscal policy, we can start talking about these other things that can and will move markets, and really just kind of put the Fed on the back burner and say, listen, we kind of know what but they are what we think they are, as Denny Green used to say. Like we think we know what they're going to do. That will ultimately actually be a pretty good thing for risk assets.
Yeah, no, I definitely see that. And I can tell you're bullish as well. So I'm assuming that that means, even though with some seasonality that's taking place, as you know, historically, we do have a bit of a sell-off in September. It's not a very good month for the bulls. But overall, your long-term view going into 2026, are you remaining bullish no matter what the Fed does, or do you think earnings are good, or what's the catalyst to keep this train rolling?
Yeah, I mean, look, I think you highlighted it right, Todd. I mean, the September seasonals are crummy. The good part is they're well known crummy. I mean, this is not a secret to anybody in the market. But the other exacerbating factor that at least for the next probably month or so is the positioning is pretty full. If you look at systematic investors, be they trend following guys, CTAs, or vol control people, or just any kind of any other sort of systematic institutional investor, their equity exposure right now is probably 75th, 80th percentile in terms of being long. So they're not full, but they're pretty full. And you combine pretty full positioning with with kind of crummy seasonals, and that's definitely it should get your attention for the next few weeks. And probably not a time to be adding on dips, but probably not a time to be kind of buying on momentum as we continue higher. Be at least my opinion on the short term trade dynamics. But look, as we come into into like later in the year and as we come into early next year, yeah, this is a market. And folks worry about being top heavy and being kind of, not, sort of distinct or like it's an expensive market. Like, top of the market's very expensive. It's being, it's very concentrated. All these things that sort of happened in the dot-com bubble that has got people sort of worried. But this is not your daddy's NASDAQ. These are companies that, that are making money hand over fist and, like having revenue growth in the 30s, 40s, 50% range, having margins in the 30, 40, 50% range, and can grow no matter what the underlying economic conditions look like. And so this is, this top of the market is driving everything else, is driving earnings at the index level, is driving productivity at the economy-wide level because they're engaged in AI and sort of the productivity enhancing aspects of things that is the most important thing we're all going to talk about for the next 24 months. And so, we do think this is actually a fundamentally driven, fundamentally supported market right now, especially at the index level. And then if you throw on some additional Fed, some additional kind of Fed certainty, and a few more Fed cuts, coupled with this AI capex boom that we're just in like the second inning of right now. Again, we think actually that the most undertold story from a macro standpoint that's in this market and the economy is going to be the capex boom that we're just really getting started. That is being obviously helped by some of the provisions inside the big beautiful bill with respect to full expensing. That's an incredibly important thing for the economy. It's an incredibly important thing for productivity, and really, frankly, a pretty important thing for the market as well as we come into next year.
Yeah, that's something a lot of people aren't talking about anymore, about that big, beautiful bill. And you are right about that, because the spending that will take place and having that push back into the economy is only going to be seen as a big positive, especially as we get into 2026 and beyond. I do want to quickly turn your attention, though, to the metals. We've seen gold hit a record high, silver breaking through 40. What's your feeling on metals? I'm sure you're getting clients calling Horizon about it. Do you think that this is just short term, or should we anticipate this going into the fourth quarter?
Yeah, I think this one probably still got a little legs. I mean, again, I got my feeling on metals are a little bit similar to our feelings on just general risk assets. It's September might be a little choppy. There is some technical resistance out overhead that other folks could probably speak to more fluently than I could. But at the end of the day, it's the sort of underlying fundamental story for why these for why kind of basically the metal space has had a stellar 2025 is pretty intact. Look, we've got a tax on Fed independence. I don't think it really goes anywhere ultimately, but it's a risk. It's a real risk at this point. And there is going to be continued fiscal spending, even though it's going to come more from the private sector, more in our big takeaway for next year is frankly like capex spending is going to be the new fiscal, like basically a fiscal stimulus. So the fiscal stimulus for 2026 isn't going to be coming as much from the government as it is from the private sector. But at the end of the day, like it's still going to boom nominal growth. And anytime you get nominal growth booming, that is tends to be a relatively good thing for some of these metals. And the federal government, federal deficit is not going anywhere but up. Like all the things everybody sort of knows, like those underpinnings are still there. There's nothing to really kind of get in the way of those. And as you have like large economies like China, trying to de-dollarize at the margin. There's no de-dollarization happening like writ large, but at the margin, folks are trying to kind of protect themselves, to protect their own sovereignty by limiting or sort of moving away very slowly away from sort of dollar-denominated assets. These are all things that are positive for the metal space. And so none of those stories that really kind of started percolating in 2025 and got everybody's attention, it probably continues in 2026. We don't see any reason for that to really kind of slow down or stop.
Interesting. So on the tariff front, the administration is now sending the lower court's rulings to the Supreme Court. They asked for an expedited decision. Looks like November is when the Supreme Court will make its ruling. And if they do say that Trump's tariffs were illegal, that means there's a whole lot of money that's probably going to be refunded to some countries. Do you see that as being, and will we have any type of negative ripple, not just in the economy, if this is the case, but what about the stock market? Do you see this as a potential challenge for the bulls?
I see it as more of an annoyance than a challenge. I mean, it's one of these, Todd, that I think kind of it just adds to uncertainty that rather than adds to, sort of does anything fundamental to the picture for the economy. Like there are lots of ways to skin this tariff cat if you're the Trump administration. If this one gets knocked down, they're going to try other stuff. Look, this is not an administration that really likes to admit defeat or admit when they're wrong about anything. And so, you should expect that they've got plan B, C, D, E, and F ready. Should the Supreme Court kind of strike these things down? So even if they are struck down, like they're probably going to come back with something else that is going to look and feel somewhat similar, have a similar economic impact. I have no ability to handicap what the courts are going to do. Like that's just not my gig. I do think we can know from the sort of how the Trump administration operates that they're not going to take no for an answer, at least in the short term. And so that to us it's more of an uncertainty heightening thing than it is sort of an economic thing. That on the margin isn't great. But I don't think it's a massive game changer for at least how we're going to view broad markets or the economy as we come into 26.
Yeah, it's a smart point. Yeah, definitely. I never thought of it that way, and I like the annoyance comment. That's I can see what you're saying. On back to the interest rate side, seeing a potential cut in rates, you would see that. Do you see that as a boost to the real estate sector? Would that be an area that you may want to consider going into 26?
Actually, it's a little bit paradoxical because if you get the look, if Trump were to get like 1% Fed funds, then you're like, let's say he can wave the magic wand and he gets the 1% Fed funds.
Yeah.
The Fed funds isn't what drives the real estate market, right? I mean, we all know that like the 10-year is what drives the real estate market. You get a 1% Fed funds, I dang told you were going to get higher 10-year rates. From all sorts of different channels, whether they be inflation expectations, whether it be Fed sort of like non-independence kind of stuff. Like it's going to be higher term. It's basically going to be higher term premium, higher risk premium, higher liquidity premium for the 10-year rates. So like we don't really want to see, if you're a real estate person, you don't want to see 1% Fed funds. Like you want to see 3% Fed funds, like kind of right on neutral in a very predictable, boring fashion. That gives at least the opportunity for basically a yield curve to flatten some, and for 10 years to get like have a 3 handle on it basically. But if we get a 1% 10-year Fed funds, like 10 years going up, guys, and that means mortgage rates go up, and that means that's not good things for the real estate sector. So we don't see this being a massive boom for real estate just because Fed funds isn't what drives the bus. But if you do kind of get there over time, over the next like 6 to 12 months, if you get like in the low threes in Fed funds, you could get functionally like a 375, 385, 395 10-year rate, and that they're talking about 50 basis points lower in mortgages, like that would move the needle, and so I think that'd be strong, but I don't think it's necessarily like an instant elixir.
Yeah, no, that's brilliant comments on that. So you guys at Horizon, I went to the horizoninvestments.com site in the news. You guys have been very busy this summer. 7 new ETFs. You got a few more coming out this year. Can you speak a little bit on the new ETFs? I know you've had a lot of success with them so far, and maybe what they cover, and what the objectives are, what you're thinking.
Yeah, sure. I appreciate it, Todd. So, look, we're fortunate, and we do have an incredibly capable team, like really smart folks, kind of thinking about these problems and developing them. Listening to our clients a lot about, do we roll out more mutual funds? Do we roll out different SMAs? What do you guys want to see from us that could be helpful to your practices? Because we serve financial advisors at the end of the day, and we're a goals-based investment manager, and so if we're going to do something in the ETF space like we've done, we really want to try to be fairly intentional about like how do you structure this stuff. What types of we're not going to be just another smart beta ETF or another kind of sector ETF or like things like that. It's just that's not really our DNA. Like that's not something where we can add value. But in terms of like producing some more or outcome oriented things, more goals based oriented solutions, and a lot of a lot of intelligent use of systematic option strategies is a big part of what we do. Is something that we're quite good at. And so for the most part, most of these ETFs have essentially like factor style underlying security selection plus a systematic option overlay that's meant to deliver a very specific outcome. And so whether it be risk mitigation or income or extra beta, basically increased sort of market participation, those are the types of outcomes that we're really looking for out of this suite, covering both domestic and international markets. And that's really kind of what we do. That's what we've been doing for 20 something years. And so this is just another way for us to express those ideas in a wrapper that can be more tax efficient, for folks, and that can be relatively helpful. But that's the vast majority of kind of what we're doing. And then there is one particular one that we've got that's called the Digital Frontier ETF that kind of speaks away from that. And that one is really sort of special in my heart because I get asked a lot. I'm sure you do, Todd, too, about like people come up and say like, how do I invest in AI? Like how do how do you invest in AI? Like if it's not NVIDIA, like how do you invest in AI?
I always say, look, go to AI and ask.
Yeah, right. So and look, in a couple of years, everyone's going to ask us like, how do I invest in quantum computing, or how do I invest in crypto, or like whatever. Like, how do I invest in these things that are buzzwordy and kind of cool, and like I think they're important, but I don't really know how to do it, and it's like super complicated. And so like, we've got that one ETF that's out there that is it's meant to try to answer that question essentially. So it's our take on how do you invest in AI and quantum and crypto and all those things sort of rolled into one kind of solution. That's sort of the outlier solution, the outlier kind of product that we've got. But everything else is quite goals based and quite systematic in the way we're thinking about the world.
Okay, I like it. Scott, you always come here on buy, hold, sell. You always have everything to say. I know when we have Toby on, he likes to talk and he asks some questions, but you always bring the knowledge, and that's all we can ask. So Scott, thank you for joining us on buy, hold, sell. For anybody who wants to check out what Scott has to say, go to horizoninvestments.com. Take a look at these new ETFs that they have, and I'm sure you can also probably get notified when they have the new ones coming out later on. But Scott, I enjoyed talking to you, and I hope you'll come back to buy, hold, sell.
Todd, always a pleasure, man. You guys are pros. Thank you, man.
Thanks a lot. All right, so next time on Buy, Hold, Sell, we have Jim Bianco. He's going to be joining the show. Hopefully, Toby's back from assignment. I know he'll have a lot of questions as we lead up to that all-important Fed decision on September 17th. So on behalf of Scott Ladner, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.